Welcome to Boston Institute of Finance, where we're going to today be talking about how to quantify the intrinsic value of a stock given a dividend with a constant growth rate. So in this case, the formula deals with three components. The fourth would be the actual value. So here we have the intrinsic value to an investor equals, in the numerator, we have dividend at time one, so basically next year's dividend, divided by the investor's required rate of return minus the growth rate of the dividend. Now, you'll very likely be given both the investor's required rate of return and the growth rate of the dividend, but what you won't be given is dividend at time one. So quite simply, how you figure that out, and what you should do to memorize this equation, is D1 equals the current dividend, which is known as dividend at time zero, times 1 plus the rate of growth. So how you should be remembering this formula is intrinsic value equals dividend at time zero times 1 plus the rate of growth divided by the investor's required rate of return minus the growth rate. It's very important that you remember it this way. Now, those of you that would move on to other things like the Chartered Financial Analyst exam or the Certified Investment Management Analyst exam, you'll have to carry this through and you can carry through this 1 plus G into infinity. So dividend at time 2 is D1 times 1 plus the rate of growth. But for the purposes of the CFP exam, all you have to worry about is dividend at time 1. So how do we apply this? Okay, here, it would be a very typical question. A client is evaluating investing in BIF Inc. common stock. The stock is priced in the market, so important fact here, at $32.20 per share. The current dividend is 1.75 per share, and BIF Inc. expects to grow that dividend by 6% per year. Forever. So they're going to grow this dividend at a constant rate of 6%. That should throw your antenna up that you know exactly which formula you're going to apply to this. Would you recommend to your client who has a required return on this investment of 10% to invest in this stock? So here, we're going to worry first about how do we quantify this, and then once we have that value, we need to understand what to do with it. So in this case, we know that intrinsic value equals D1 divided by R minus G. And we said that that equals D at time 0 plus 1 plus the rate of growth divided by R minus G. So in this case, we would say 1.75 times 1.06, which is 1 plus the rate of growth of 6%, divided by 0.10 minus 0.06, which is going to equal 1.855 divided by 0.04, which equals 46.38. Well, 46.375, but we'll round up to 46.38. So what we're saying is this investment, which the market has priced at $32.20, but right now we don't have to worry about that, right? We're not worrying about what the market has this priced at. What we're worried about is what is it worth to us, right? To our investor who has a required rate of return of 10%. So we have a dividend of $1.75 per share, which is expected to grow by 6% per share. So we create that dividend at time 1 right here by multiplying that dividend at time 0 times the 1.06, which is 1 plus the rate of growth. Divide that by the investor's required rate of return, which they have to get. That's their hurdle rate for this investment. So they have to get that 10% per return on this investment minus the 6% growth rate, and we come up with $46.38. Now, the last part here is, would you recommend that this client invest in this stock? I'm not sure, right? So I know two things. I know the stock is trading in the market currently at $32.20. And I know that we calculated that the intrinsic value is $46.38. What would I do? Well, if you memorize this slide, how do you apply this? If the market value is greater than the intrinsic value, so MV is greater than IV, then you want to avoid the stock as the expected return that you're going to get from this is going to be less than your investors' required rate of return. They're not going to be happy. It's not going to hit their hurdle rate. If the intrinsic value is greater than the market value, so IV is greater than MV, then you do want to invest in this stock or undertake the investment, as the expected return will be greater than the investor's required rate of return to get into this stock. So as you'll see here, expected return obviously is ER, but in finance, the required rate of return is usually denoted with a lowercase k. And if the market value is equal to the intrinsic value, so here MV equals IV, then you want to invest in the stock as the investor will realize their required rate of return. So here we said that the market price was $32.20, or market value. So we'll cross that out and we'll say market value. And we said that we calculated our intrinsic value on the stock was $46.38. So in this case, the intrinsic value is greater than the market value. So we would absolutely recommend to the investor to go ahead and invest in this stock, as they're going to get a return where we would expect that they get a return that would actually far surpass their required rate of return. So good luck, and we'll see you in the next formula.